We'll let everyone get in here for a minute and then we'll start the fun activities. All right. How you doing, Mike?
Very well. Very well. How was your new year?
It's fantastic. Fantastic. Welcome, everyone. I see people are starting to flood in. I'm going to kick us off in about 30 seconds and we'll have some fun, shall we? All right. Well, so we got a good amount of attendees. I guess a historic year in the market will do that, huh, Mike?
Fun stuff.
Fun one, absolutely. All right. Well, we try to start these things on time and end them on time. We're scheduled for a half hour. We will stop promptly by then. Of course, we will send this around and share it, so feel free to watch it over and over again or share it with a friend or a colleague that you think would appreciate it. I'm Andrew Rosen, president of Diversified. We have our CIO, Mike Horwath, here. We like to do these each quarter just to give back and keep informed of what's going on and how we see things here at Diversified. Everyone is muted and will remain muted, but what I will do is feel free to ask questions. Assuming they're appropriate and make sense and we can fit them in, I'll read them to Mike, have him speak to them. Just type them in the little chat. I can see it here, and then we'll rock and roll. So, Mike, teach us, my friend, about what we need to know about the markets and where they've been and where they're going.
Awesome. Well, thank you. As Andrew said, my name is Mike Horwath. I'm Chief Investment Officer here at Diversified. So first off, Happy New Year to everybody. And thank you for hopping on. This is always, it's always fun in the sense that you kind of get to turn the calendar, get to look back at what happened, why it happened, and then kind of start to formulate the script of what you think is going to happen next. And we'll kind of go through all of these things sequentially here. But let's just kind of start with what happened in 2022, right? There's a lot that happened. But first and foremost, everything centered around inflation, right? Inflation drove everything. For perspective, headline inflation, so headline includes both food and energy, never dropped below 7% in 2020. The Fed's target for inflation over the long term is 2 to 2.5%, right? They'll say 2, there's some flexibility there, but call it 2 to 2.5% low positive inflation. And we never saw a reading below 7% on the headline side, right? When you include energy and you include food. But inflation drove everything. As part of that, the Fed, which has that dual mandate, right? They have two jobs. It's keep low positive inflation, and it is to keep unemployment, what you would call full employment, right? Keep unemployment low. Call it 4%, under 4%, somewhere in that neighborhood, but a strong labor market. What we've seen is that the labor market is quite strong. It has remained strong, and their entire focus has been centered around the inflation conversation. So to get inflation down, what we saw in 2022 was the Fed raising interest rates substantially quicker than anybody had expected, than they probably expected. I should say probably, than they explicitly said that they were going to do. There's a lot of things that kind of transpire. We're going to go through the inflation kind of trajectory because it's a nuanced conversation. I know people hate nuance, but it should be discussed with nuance and go through different parts of it. But in the end, right, the entire point was to raise interest rates substantially throughout the year to slow inflation. What that does is slow the economy, and it affects asset prices. Higher interest rates hurt the current values of financial assets, both stocks and bonds. For stocks and bonds, the true value of a stock or a bond are the discounted cash flows. For a stock, that is earnings, cash flows. For a bond, that is the interest payments. They are discounted then to today using interest rates. Higher rates mean the value today is less. That's simply what you saw where higher rates affected financial assets. People look at the labor market as a really positive thing, and it has been, right? The labor market has probably been one of the biggest reasons why the economy has been set up to sustain higher interest rates and has really withstood everything up to this point. But it also puts the Fed at a tough perspective. Right? We can go through this a little bit later, but the entire point is it is hard to get inflation down when you're seeing such tight labor market conditions where wage growth has been growing so quickly, and it hasn't been spiraling out of control where it's gotten so out of control, but wage growth has been pretty substantial. As part of that, as people make more money or as the demand for workers, fewer workers are looking for jobs, the demand for workers is pretty high. Wage growth has been pretty substantial. And when wage growth is substantial, people are willing to spend money on higher and higher prices. So that has contributed to the tight labor market, along with inflation just remaining quite stubborn. So 2022 was all about inflation just not coming down, right? Not being the transitory that the Fed spoke about. And we'll kind of talk about that word here shortly. Going into 2023, right? The focus now turns to the Fed has done most of its job. Inflation's peaked. It's coming down. It'll take time to get from where it peaked down to that 2% target. We're not talking 2, 3, 4 months. If at the end of the year, you'll see my projection, but if you can get down in that 3 to 4% range, you're going to be happy. But the Fed has largely done its job. Now the focus is on what is the damage that they had to do to make that happen, right? There's usually a lagging effect, and we'll see what that looks like in terms of corporate earnings, GDP growth, and really the strength of the consumer moving forward. So markets, what they do last year, I think, focused on the highlighted numbers, right? That's the global stock market measured by the MSCI All Country World Index, down 18%. And you saw the bond market have its worst year in decades, right? Bond market was down over 13%, just about 13% for calendar year 2022. You can see across the board, this wasn't a one asset class issue. This wasn't a 2 asset class issue. Unless you really own cash or commodities, your portfolio was down. You saw, it stemmed from large cap to small cap, US to international, within international, developed and emerging. You saw it within taxable fixed income and tax exempt fixed income. Higher rates affected all financial assets outside of cash pretty much equally. So it's pretty much cash and commodities were the only things that really had any benefit to portfolios in 2022. Higher rates affected all of these asset classes really equally. The story is inflation. And I think the important part to remember is everybody wants to put one thing out there as inflation was caused by this. This should not have happened, right? It's never one thing. There's no singular cause. The chart on the right are the 3 major CPI categories: shelter, services, and core goods. And their contribution over the last 6 or 7 years to inflation. And you can see, from 2016 to 2020, it was pretty stable, right in that 2% target, a little bit under for the most part, with shelter, right, owner's equivalent rent, things like that being the primary part of it. Going into 2021 and into mid 2021, you see pretty much all 3 areas into a changing effect, right? It changed over time. We'll talk about this in a second. Goods, services, and shelter have all contributed to the rise in inflation and the persistence of inflation. This goes back to monetary policy, fiscal policy back in the wake of the pandemic, supply chain issues because of the pandemic, and then when in February of 2022, Russia decided to invade Ukraine, and all of a sudden the commodity world gets shook. A lot of things are going on, and a lot of things are contributing to the inflationary backdrop. In 2022, headline inflation, like I said, did not drop below 7, and core, which strips out energy and food, never dropped below 5.9. Those numbers are a year-over-year basis. So that would reflect July of 2022 against July of 2021. Those figures are way too high. The Fed is going to work to get them down, and their tool in their tool belt is to raise interest rates, raise short-term rates. The good news is that inflation has appeared to peak. All signs point to inflation coming down across the board, but it's going to continue to take time, right? The Fed will not wait to stop will not wait till inflation gets down to their target to stop raising rates. Right? What they want to see are the fundamentals below the surface that give them confidence that they can pause and reevaluate, which we believe is pretty close. Right? There's likely to be one more interest rate hike, maybe another, but we're one or two hikes, which are going to be smaller, from being at least done for the short term with interest rate hikes. Barring anything crazy happening with inflation, we would expect that at that point, you're going to start to turn the corner to start focusing on interest rate cuts, not probably the end of 2023, but going into 2024. The Fed has likely gone past their target. They'll need to bring it back down here in the next year or two. But going back to that word transitory, I want to make sure I'm going to get like the people are going to have the pitchforks out because I'm using this word, but this word was used a ton in 2021. And the Fed wasn't wrong, but they were wrong necessarily on the timing. And if you kind of unravel what happened and you look at that chart here on the right, what happened in the wake of the pandemic was unprecedented fiscal and monetary policy, right? The amount of stimulus, the checks that were getting cut to people. As part of the pandemic, though, what happened? Countries were shut down. Goods were just not being produced. So you have checks going into people's hands. In theory, demand increasing, and not only demand increasing in overall, but you have them because people can't travel. Goods all of a sudden are quite possibly the most sought after point right there, right? People can buy goods. You're not going to go travel, so no one's going to be spending money on services. So you see core goods, the demand increasing because of an immense amount of fiscal stimulus. And then on the flip side, you see, the supply of goods extremely low because countries are just shut down. So when you look there at the beginning of 2021, mid 2021, the blue bar is a vast majority of the inflationary backdrop. Goods went out of control. And what we've seen over the last 6 to 12 months has been this unraveling, the spending of all of that stimulus, the resurgence of supply chains, and goods have gone the other direction, right? Goods are really not contributing very much to the inflation conversation. But what happens is now people can travel. All of a sudden, services are increasing quite a bit. So now we're seeing services and then shelter, right? And shelter is just naturally this low interest rate environment that had to be changed, but you saw housing prices increasing quite a bit. You saw rents increase, and there's just a lagging effect with regards to shelter and rent. When they measure CPI, they're using usually a lagged effect for rent prices, but we're seeing the underlying components that rent's going to come down, housing prices will come down. Are they going to come down to where they were, 2 years ago? It's going to probably take some time for that. But you're going to see the components. You've seen goods already, start to happen. This all is playing through with what the Fed has, spoken about, at least to some extent, right? They had to raise rates to get some of the other components under control, but it has peaked and it's going to continue to slowly come down. This is the story. The bottom line is the end of 2021 interest rate yield curve. Upward sloping, pretty normal, very low, right? It was a low interest rate environment. Rates were at in the cellar. The long end of the curve, the 30-year, the 20 and 30-year part of the curve is really accounting for what long-term inflation and growth are. Pretty spot on to what you would have expected. And what have we seen? The yield curve has completely inverted, meaning the short term is higher than the longer term. The Fed has pushed up short-term rates so high that this yield curve has completely inverted and the entire curve in general has increased. Those higher interest rates have been just the massive source of market volatility. And speaking to that, when you start to look at why markets fell, right? You could talk about, this or that, right? Earnings or growth, or are we in recession? In 2022, markets, financial assets, stocks and bonds pulled back because of higher rates. If you look at the right-hand side of this is the S&P 500, right? So if you take the 500 largest US companies and say, okay, the price return, I think this is through December 22nd, was about 20% negative. If you use the math behind it to figure out why it fell 20%, it is entirely due to what's called multiple compression, just meaning that higher interest rates means people are willing to spend less money per unit of earnings on those companies. Not because earnings expectations fell. Earnings growth is the line above 100. You see, there's still expected to be some earnings growth from a corporate perspective. But you saw that people weren't willing to spend 22 times earnings, right? You hear the term PE ratio, the price to earnings ratio, which is one valuation measure of how expensive the market is. You're talking 21, 22 times earnings going into 2022. Well, that's okay when interest rates are at 0 to 0.25%. When you're up above 4%, you're not going to be able to withstand those types of multiples. And we've seen that come down to 16.6 times earnings. As rates have risen, multiples that investors are willing to pay is now going to go down.
Mike, we have a question, which I think I can probably answer. It's from a client that says, agrees that it'll take time to go down. Are we at Diversified adjusting projection from when we model from 3% that we historically have done? I can tell you, because I work a lot with the modeling, that no, we're not adjusting that, because what we've used 3%, we generally use long-term averages, and 3% is essentially even a little higher than the long-term average, but at your historic average. So from a modeling standpoint, any of the planners can adjust so you can see the impact of it on the spot. But I think from a long-term planning perspective, using the historic rates is the best case scenario. Just like we're not going to model out next year that the market's going to go down 18% every year. Yeah. It's more of a historical average.
Yeah, I wish I had the charts with me, but if you look at market expectations for inflation 5, 10, 15 years out, you're living in that 2 to 2.5% range again. The old adage is you don't fight the Fed. If the Fed's targets 2 to 2.5%, they're going to get inflation to 2 to 2.5%. With that said, it would not surprise me if over the next year or two, the Fed has to live with a 3% inflation rate. I think 3 they can live with, 5 they can't. So, we've always modeled, as Andrew said, kind of that 3%. You could look at 2 or 3, which is, 3% has been our conservative estimate over a long-term period, because we've seen it's closer to 2 over the longer term. If you look back the last several decades, but we have not adjusted, because I don't think the long-term expectations for inflation, maybe the short term does remain above that 2%, 2.5%. But yeah, long term, we still look at that space for expectations. That's a great question. But kind of getting back to what sources of what happened in 2022, entirely driven around market volatility, entirely driven around higher rates, inflation, nothing really to do with, everyone wants to talk in recession, corporate earnings. They're very important conversations, but that's not what affected really asset prices here in 2022. And I think it's important to keep that perspective, because it's hard in the sense, we're going to talk about bonds in a second. It's hard when markets fall to reset your expectations or look at the bright side of things. One positive for investors coming into 2020, 2021, if you looked at expected long-term returns in financial markets, they were a little bit disappointing, right? At least from what investors should have, or at least traditionally have expected. And the reason was just assets were kind of expensive across the board, especially within bond markets. What's happened here over the last 12 months has been markets getting cheaper, right? Markets falling, and we talked about earnings haven't moved, but the prices of stocks have come down. So they're cheaper. The good part for investors should be that there is a pretty strong correlation. I think there's a strong relationship between that starting valuation of where you buy a stock, right? Cheap or expensive, and its long-term return. In the short term, the relationship is extremely weak. But as you go longer and longer out, the cheaper you buy securities, the better your long-term return. Moral of the story is, now when we look at a 16 times earnings starting point today versus a 21 or 22, our expectations for returns in equity markets all of a sudden are 3% annualized higher over a longer term, call it 10, 15-year period, which is important for investors to remember. Not guaranteeing that by any means, but price matters. I was having a conversation with somebody the other day about just an individual company, the stock, and it kind of got around, I think it became a little more emotional for the other person about what they like about it. And my point was, as an investor, you should be open to buying anything. And all that matters is the price you're paying, right? You'll buy anything at the right price. And we should think about stock markets and asset classes and different things like that from that perspective. But I'm about to put out a newsletter next week. And anybody who wants to read it, I encourage you. There'll be some of this stuff in there. And there's going to be, I can expand upon things more in that forum. But that newsletter, the title is going to be, when in doubt, zoom out. And when you zoom out of what's happened, it starts to give you perspective of what equity markets have done over longer terms, even if you start at the worst possible times. 2022 was not fun for equity or fixed income. The future is definitely brighter because things are now cheaper. Doesn't mean the short term or 2023 is going to be rosy, but I think the perspective of where you're buying assets, where you're buying stocks, where you're buying bonds is much more attractive than what it was 12 to 18 months ago. Go ahead, Andrew.
And it's a great read for anyone that hasn't. Your quarterly newsletter has gotten quite fantastic, if I must say so, and really informative.
Oh, thank you. Appreciate it. It's fun. It's fun to put together. Flipping from stocks to bonds, this is where we are pretty optimistic. It was unprecedented. We talked about over the last several decades, the worst calendar year in the bond market was negative 2.92%. 2022 was negative 13.01%. It was a rough year for bond investors. There was a point during the year where if you owned $100,000 of 30-year U.S. Treasury bonds, so a 30-year bond backed by the U.S. government, that the value of your bond went from $100,000 to under $70,000. Doesn't mean that you wouldn't get $100,000 back in 30 years. But the point being is the value that you saw on a statement was down over 30%. That's how quickly interest rates rose. Similar to stocks, though, what we saw in 2022 has created a ton of opportunity moving forward within the bond market. What you see on the screen is the gray being the yield of that specific asset class within bonds in October of 2021 versus October 2022, the same asset class, what that yield is of the index of that asset class. Across the board, you saw yields at least doubling in many asset classes. You are now seeing investment grade corporates, high quality treasuries, just the overall investment grade market yielding above 4 and at times over 5%. You see what those yields were 12 months before that. That's a very different conversation. That's a very different conversation for retirees and investors who have bonds as part of their portfolio or are looking to add to fixed income as part of their portfolio. So we look at bond yields as attractive, and we're very optimistic for bond markets going into 2023. And we believe that they're going to get their diversification benefits moving forward. There'll be that relationship normalizing now that the interest rate hikes are not necessarily the concern anymore. Now it's turning to economic growth, corporate profits, unemployment, things like that. Predictions. So I will, in full disclosure, Andrew and I debate this. I hate these things because by January 15th, you're ripping it up, throwing it in the garbage. But I think it's important that expectations and predictions should drive how you're positioning portfolios. These types of predictions are trying to understand where markets are going, what are the things that we need to look at, and we try to put some thought behind what we believe will happen moving forward. In 2023, look, I'm not saying anything outrageous. Inflation is going to moderate here in 2020. The Fed has assured that by raising rates as quickly as they have. I still believe, I think expectation should be that there is a pretty sizable chance that we land over the next year or two with inflation above 3%, where the Fed lives with it a little bit higher for a little bit longer. Doesn't mean that they still don't want inflation down to 2.5%, but to get down to that level very quickly is going to require a lot of work. Inflation will come down, but we still, at least my expectation is that it actually ends 2023 above 3%. I also believe that the Fed funds rate, right, the rate at which short-term rates are set from the Fed peaks in the first half. I think they're going to stop after 1 or 2 interest rate hikes, and the Fed funds rate will peak, and investors will start to look to now a pause, followed by some sort of cut at some point in the 6 to 12, 18 months following that point. Sorry, go ahead.
Yeah.
No, I was going to say, in terms of the economic growth backdrop, look, everyone wants to talk recession. I think a recession is kind of irrelevant. Markets are already know economic growth is going to slow. Whether it gets to below trend, right, a very low positive figure, or goes slightly negative into more of a recessionary environment, we're kind of talking about, very, very close things, things that maybe are nuances and not that important. Economic growth is going to slow. That is the most important. We believe, though, it's not going to be anything to the tune of 2008 that we saw. It's going to be more shallow. That's what the projections look like, the manufacturing information that's coming out. It looks like more of a shallow, short-lived recession than anything super deep or long or anything of that nature. Big part of that, the unemployment rate in the labor market. Labor market is going to weaken. You're going to hear unemployment increase. When corporations get concerned about their top line growth or top line, they're going to cut their bottom line to try to maintain profit margin. The most expensive thing that they have on their books is labor. They're going to cut. It's going to happen. Expect it. Unemployment is going to increase, but not to any extent, a crazy extent. You're likely to see it's going to go up above 4. Our expectations probably cap somewhere in that 4.5% range. So from 3.7 to 4.5, which is still a decent rise. It's a necessary weakening in the labor market. And then, as I just said, fixed income markets fully believe that they have a big bounce back year in 2023. I'll go through this quick for the sake of time. Where do we go from here? Our focus is now on consumer spending and earnings. Now that the Fed's work is mostly done, what's the impact? What sectors and what businesses can withstand those higher rates? And what happens with economic data? What's going to happen with manufacturing activity, consumer spending, economic growth? These are all the things we're looking at to help drive what we believe, the first half and then the second half of 2023 really look like. Inflation is still going to drive everything. If inflation keeps coming down, the Fed will stop and will pause and will have that confidence to do so. And we believe that, inflation does look like it has peaked in 2022 and is coming down meaningfully, especially in some areas. How are we positioning portfolios given that scenario, given this backdrop? The best way to characterize it is we're defensive, right? We are defensive in both equities and fixed income because we don't see the need to take excessive risk right now in either space. We believe we're kind of late economic cycle. We still need to see, the economic growth conversation really kind of get its footing of where it's going to ultimately go over the next 2, 3, 4 quarters. So high quality across the board, meaning we're going to be underweight some of the higher risk, higher beta areas. We're overweight U.S. over international. Not only do we think the U.S. is better positioned, but the stronger U.S. dollar has naturally been a stronger or really headwind for international equities for U.S. investors. So we're going to stay overweight U.S. at this time, and we're overweight U.S. large cap over small cap for just higher quality, better businesses to be able to withstand slowing economic growth. We still have an energy overweight. We still have an overweight to semiconductors, both areas that we see, even with the volatility that we see in 2022 for both are well positioned moving forward. In the fixed income side, being high quality means we are underweight non-investment grade fixed income. We're going to be underweight high yield, EM debt, leveraged loans, the areas that are higher risk, they're lower credit quality, because what happens is in recessionary environments or late economic cycle, they're the first areas to see default rates pick up. What happens then are what are called spreads start to widen, meaning they're typically sold off So even though they're yielding some really nice figures, to us, the yield you're getting from high quality fixed income, you don't need to take that excessive risk today. For both the small cap conversation and high yield or emerging market debt, things like that, a little higher risk, we see that opportunity coming. We just feel like we're too early. Though all those areas really do well coming out of these kind of slowdowns, and as things pick up and that recovery phase takes hold, we just have to be careful not to jump in too much too soon, because you're likely to face more downside if that does continue.
Mike,
So, happy to turn it over to Q&A if you like.
well, I think you got us right to the end, as a matter of fact. And I want to be respectful of everyone's time. So we will share this. I hope you found it educational, informative, as I always do, Mike. I always learn listening to you talk, and I want to thank you for all the hard work you put in. And I know last year was a challenging year, and this year, hopefully some more calm in the seas, but we know we put our faith in you, and I think everyone here can see why. So thank you, everyone. We appreciate you very much. We'll share this. Let's make this year a great year, and keep looking out for all the information we share, because we're constantly trying to keep you informed of what's going on and why. And I think it helps answers a lot of questions about how we see the world. So thanks, and take care, everyone. Happy New Year. Bye.